So starting with part 3, it's all about the money. So we're going to talk about equity, syndication, leverage, lending institutions, and parameters, finding the right deal. I'm going to repeat the disclaimer that was said from the beginning because as we're talking money, then people start quoting examples and trouble could happen. So I'd rather reread the disclaimer for you here. So section 3, page 2. This presentation is for educational purposes only. Please consult with an accountant and/or attorney for any legal or tax advice. All materials, content, and forms contained in this presentation are the intellectual property of Eastern Union Funding and may not be copied or produced, distributed, or displayed without Eastern Union's express written permission. You decided to invest in commercial real estate. The first question that you have to ask is how much equity do you have? Because if you only have $1 and a bank is willing to lend you 75%, it means reverse engineer it. You can only borrow. You can only buy something for $4. You have $1, the bank will lend you $3. You have $100,000. You could buy something for $400,000. And keep moving that math all the way up. So once you have what you have, how much do you need? And how are you raising more? So if you only have $100,000 to yourself, you can buy a $400,000 building. What happens if the buildings in the area or the property types you want to buy cost $1 million? Then you have to be able to know how much more do you need. If it costs $1 million to buy a building, let's assume with closing costs for the purposes for the purpose of right now. Again, let's use an example. It's $1 million to buy a building. It's $50,000 in closing costs, and a bank lends you 75% of your purchase price. So you're buying a building for $1 million. The bank will lend you $750,000. And if your closing costs are $50,000, you would need, in order to buy this building, $300,000, $250,000 for the purchase, from $750,000 to $1 million, plus another $50,000 in closing costs. Banks typically do not lend you your closing costs. They lend you just based on your purchase price. So if you only have $100,000 and you're buying something for $1,050,000 with closing costs, you need $300,000. How are you raising more money? Where are you getting that money is the crucial question. If your answer to the last question is you don't have a way how to get that more money, and you are doing it by yourself, then you can't buy the $1 million building. It's over. Don't waste your time looking at any deal above $400,000 plus the closing costs you're going to need. And that's a big part of the mistake that people make. They focus on a lot of things that they focus on. They focus on things that they can't get to the closing table on. So the same example that I end up looking at when I'm hiring somebody, I can tell someone, you're looking for a job, the person says, yes, I'm looking for a job. I turn around to the person, I say, what do you need to make? And the person says, let me hear about the job first. I say, listen, assuming the job is amazing, what do you need to make? Because if you need to make $30,000 a year and I'm paying $20,000, it doesn't help you. You need to make $1 million and making $500,000, it doesn't help you. No. It could depend. Depending on, you're wasting your time again. If I told you I'm negotiating the final salary now, I hear you. But tell me your range. If I'm in the ballpark, okay, you have the details, you can stretch. But if it's amazing, that's the same mistake that people make here. You want to focus on not wasting your time. If all you have is $100,000 and all you can get from your friends and family is another $250,000, another $200,000, then the most expensive building you could buy in today's market is $1 million building with $50,000 closing costs. That's it. Don't even look at the deal for $1.1 million. Don't look at the deal for $1.2 million. I tell a lot of people that the negative of being in the commercial real estate business as a broker, whether it's a mortgage broker, sales broker, leasing broker, coming in as a broker, the biggest negative is that you don't make a stable salary. When someone makes a stable salary, let's say someone earns $100,000 a year, which is approximately $2,000 a week. So they know they have to go buy a couch for their house. They budget. The price they're spending on this couch, $700. So when they have enough put away for that $700 based on whatever they're doing, they go to the store, they buy a couch, and they go home. The person that still shows them a couch for $1,000, if they're normal and stable, they don't buy it because they made a budget for $600, $700. That's the price they buy it. The problem when you make $100,000 in spurts, $5,000 here, $12,000 here, $6,000 here, then you go dry, then you go to $21,000. What happens when you close that $21,000 check? Same budget. You walk into the store, you see that couch, and they show you a $1,000 couch. You think to yourself, just have the money now. Who said I'm working on a lot of other deals? Who says it's not going to close? Let me go. Before you know, you buy that. And that's why most people on commission end up living at a 150% increase in their living expenses. Because every decision they make, they either live poor if they don't have any money that week, they didn't close anything in a while, or have tons of money, and if they splurge that money, they go spending it. If you're buying real estate, focus on the bottom line. If you have $100,000, the game is over. You can't buy anything more than $100,000 to leverage. If you have $200,000, so on and so forth. The next question that goes along with this is really not so much how much are you raising money for, how are you raising the money, but what cost are you raising the money? And if you come in and say the cost that I'm raising the money, my return I have to deliver to the investors at 10%, then not only could you buy a building, you cannot buy a building for more than $1 million purchase price, but that building must throw off a cash-on-cash return of 10%. So then it makes it very easy. People say, I look at deals, what should I focus on? Let me tell you something. First thing you focus on is the purchase price. The second thing you focus on is the cash-on-cash return. If the purchase price is above $1 million, don't look at any deal comes your way for above $1 million. Every deal, tell the broker. A deal offers you $1.1 million. Before you even waste your time, tell the broker. Is the guy willing to sell for $1 million? No. He has offers above that. Okay, thank you, move on. But people make the mistake. It might be a great deal. If it's a great deal, let me try. If you don't have the money, you're wasting your time. If your cost of capital is 10%, let's remember when you ask someone what return they need on their money, and the person tells you, I need 10% on my money. You ask the person, why don't I get you an amazing deal? If you finish no matter what, 10% is the best. What are you wasting your time working on deals for? And so many people, it's the other way around. They spin the wheels, they work on deals just in case. Pick your choice. Don't waste your time. And like I said in previous sessions, this business is about trust. Trust is not just, are you honest? You say A, and it's really A. You say B, it's B. Black, it's black. White, it's white. No, trust is also, can I trust you in the sense that, do I have the faith and confidence that when you tell me you will close this transaction, you'll get it closed? That you actually have the proceeds to close it. The worst thing is you go down the line, come to the closing, the guy doesn't have money. If he doesn't have the money at that time, something came up, okay, still disturbing. You tell he never had the money. So you didn't negotiate in good faith. What were you thinking? So I give an example. It says a few times, someone has a job, starts at 9 o'clock in the morning. They come in, they show up at 9:30. Why were you late? There's tons of traffic. How long does it take to get to get here from work? With traffic, 25 minutes. You know, if you left at 9:05, it wasn't possible to be on time. We left at 8:45, it took 45 minutes of traffic. So you didn't give enough time. It's like you mistake, even you didn't give enough time in the normal day. So the same thing is over here. You want to go into a situation where you know first how much money you have, how much money you could get, and what's your cost of that money. And that narrows down the box, potentially, what you're able to go ahead and look for. Raising equity. There's 3 parts of that money we just discussed, how people buy deals. And this is the evolution, how it used to work. People used to only buy buildings themselves. They saved up money. I have $100,000. I know a bank can lend me 75%. I'll buy and make a building for $400,000. So there's a building for $600,000. I wouldn't buy it. Over time, and in certain situations, people said, you know something? I buy real estate, and you buy real estate. I could afford $100,000. You could afford $100,000. Why don't we together buy an $800,000 property? So they went in literally as partners. Now the legal terminology for this is that when I buy a building, I'm the buyer and the owner, whatever you want to call me, I'm one person. When I take in partners, there's a LLC that gets opened up, and there's partners in the LLC. The GP is called a general partner. And the general partner that's on this transaction is the person who makes all the decisions. So if I literally go into business with somebody else, then I buy a building together, we are co-GPs. We both are buying this building together. So for many, many years, all real estate that was bought typically by co-GPs. 2 people had money, they put the money together. They might make an agreement that one guy gets a management fee for running it, but typically they were partners, and that's how deals went. A new thing came in on a mass scale called syndication. The syndication is, why are you only buying that building for $400,000 or the 2 of you for $800,000? There are a lot of rich people in the world. And leaving regulation aside, have the laws, a lot of laws, it's not real estate laws, it's securities laws about raising money. Well, the idea is, why don't you go out and raise money from rich people? The government coins a rich person as an accredited investor. It says that if this person's, I think the way it works is if someone is worth $1 million, not counting their home, or they made $250,000 in each of the last 2 years, the government calls them rich, which means that the burden, no one has to worry about, you don't have to give disclosures on, you hear a lot of disclosures to protect people. The government says that this person is at this level, they're called rich enough that if they made an investment, they were smart enough to make their own investment, and no one pulled the wool over their eyes, to a certain extent, but in the general context of it. So as an accredited investor, a person says, why don't I go out tomorrow morning and raise money? and they go around to the doctors, the doctors, lawyers, business friends, people who own businesses or industries, and they'll tell them, listen, I'm buying this building for $2 million. I need $500,000 in order to buy the building. The two of us, the two GPs, are putting in $100,000 each into this. Are putting $100,000 each into this deal. So we so far have $200,000. Can you invest with us? Aside from the $200,000, we want to raise $300,000, and they're willing to do it in smaller increments. They're willing to do it at $50,000 at a clip, $75,000 at a clip, $100 at a clip. But the main thing is not so much how much they're doing it at a clip. The main thing that they're doing it is that those other people are called limited partners. They do not have a say in what they're doing. They don't have a say in the deal. They invest their money, and they will get their percent of the profits that they're supposed to get for the money. And typically, the way it works is that they would have an arrangement worked out between the GP, the guy, the syndicator, the guy buying the building, and the LP, which will be is that the GP will tell the LP, I'll give you a preferred return. I'll give you some interest rate, so to speak, on your money. 8%, 6%, 7%, 10%. Usually today, it's in the range of 6 and 8%. That's the range of it. You'll get a preferred return, a cash-on-cash return, somewhere between 6 and 8%. And then, after you get that money, if there's extra money, we will split it. 70 or 80% in the favor of the guy who gave the money, the LP, and 20 to 30% in favor of the GP. So I want to say this totally different for those that are totally new to this concept. You could understand that if you had this great idea, and you had this great idea, and you wanted to open up a business, and you found someone with money to invest in your business, you would go out there and find that person to invest. But you tell the person, I have to make money. So you tell the person, after you get your money back, I want to keep half the business, or 25% of the business, or 30%. There's a number I would keep. So when I'm starting a business, I'm the GP, I'm the general partner, and LPs give me money. Basically, and real estate works the same way, but it's very common. LPs, limited partners, invest with GPs. And the GP makes their money by promoting, by getting a profit, sharing the profits, what the LP should make. Normally, if 5 people put $100,000 each person should get 20% of the profits. The GP will tell the LP, of your 20% profits, give me 30% of it. Meaning, if you're supposed to make $100,000 this year, let me keep 30,000 of it, and you keep 70,000 of it. And that difference is how that GP makes the money. So GP goes tomorrow morning, buys a building, and this way they can leverage up and buy larger and larger buildings. And that's how transactions, that's what you talk about understanding finance. It's not just understanding mortgages, it's understanding the debt, the mortgages, understanding the equity requirements, understanding the different options on how to go out and go raise money. So in the simple form, I could buy a building with my own money. Totally. I could buy my building with my own money and or partners that are even partners, code-GPs. Or I could go out and skip the code-GP, or with the GP, go out and raise money from LPs, limited partners. What makes it complicated a lot of times is as follows. You have a person that is trying to raise a big deal. He has to raise $20 million worth of equity. He's running around trying to raise it as a GP. He's in contract, he's for the building, he's buying a building, $80 million, let's say, it's $20 million worth of equity. He's up to $12 million. He's having a tough time raising the money. He would sometimes find someone else that's also a syndicator and say, listen, let's together, finish raising this. The guy goes, how am I going to make money? You're making the money. And they'll agree, either I won't promote your money you bring into the table. So we need 20 million, you'll bring 8, and I'll bring 12. On my 12, 12 to 8, 12 and 20 is 60%. So I'll get 60% of all the profits will go to me and my LPs, and 40% of the profits between you and your LPs. It's possible that in that same exact deal, someone who's investing, an LP is investing in that deal, is not getting the same return as everybody else. He could have gone to syndicator number 1, and he's getting this promote or this preferred return. And syndicator 2 is offering different. There's no one way that real estate happens. As much as you see people, and now even furthermore in deals, like the unwritten rule, there's no one way for everybody. If someone's looking to raise $12 million, and if you're promising an 8% return on the money, and someone walks in and says, listen, I'll give you $3 million of the 12, you could be sure in a very high probability of cases, high percent of cases, that person's not getting an 8% preferred return. He's getting a 9 or 8.5, something better than everybody else. Because wholesale retail, he's coming over to GP and saying, GP, I'm stroking you a check for $3 million of what you need to raise. I want a better piece of it. But that's how real estate, when you see real estate deals going down, a very, very, very high percent of all new purchases today are going down with syndication, where there's LPs and GPs investing in the deals. The most common exception when it's not happening is when you have a very, very wealthy real estate family that's been in real estate business for multiple generations. In that case, very, very high probability of those deals are going down with no outside money. The money's being stroked just by the founder themselves, and that's it. Because they're the other way. They have so much money, they want to put it back in, and they're not looking for the returns. They're keeping it for generational. So the typical deal, you hear of a friend of yours buying a piece of real estate, people buying deals, even rich people that you think to be rich, they're syndicating it. It's OPM, which is aligned for other people's money, and that's how they're making their money from there. Equity in hand. You put together funds and are ready to go into your first deal. Now that you have the funds and resources, you have an idea of what size and type of deal you're looking for. Now you have an idea, not only do I have my own money, and maybe partner's money, I'm confident I could raise LP money to help me put it all together. So based on that, I know how much of a building I can buy and what kind of return I would need. A syndicator needs to understand the motives behind his investors. Are they in for the long haul? Do they intend to flip immediately? They need a monthly cash flow. So I just discussed up until now just one simple part of the process. I'm buying a bill. I have cash. I'm willing to invest the cash, but I need to see a 10% return. So I'm an LP, 10%. The GP will put the whole deal together. When he needs to see a return, and he's raising money, the best syndicators have a full understanding of what the motive is behind each of their investors, and then they know to what extent later on is there room if something comes up, who they could bring in, who they could take out, how they could renegotiate. Because if one person's main objective is to flip immediately, I like short-term deals. I think real estate's good for the next year or two. I'm nervous in 3 years from now. So if I was investing potentially, my attitude is going to be is that I want a deal that can be out of here in 2 years. So I'll take a little bit less money maybe if I know for sure in 2 years. But if you want me to stay there for the long term, there better be a very, very high return. On the other hand, there's other people just the opposite deal. If it's the short term, what am I doing with my money in 2 years? I better make a nice return. So long term, it's stable. I could count on it stable every year for the next 20 years. I'll take less. There's having somewhere in the middle. It's understanding the motive. Understanding the motive of the seller, the buyer, the investors. The more you understand about the people around you, the better educated you are, the better informed. This way you can make better decisions in the negotiation where you're able to find that weak moment, a weak link to know how you could provide that added value. If you come to a deal and realize that the reason why this person is having a tough time selling it is because everyone's viewing it one way, and you know people have a different view of the world, take the best example, retail. Several years ago, you had people who viewed retail was going to be going amazing, and if people already saw, no, retail's going to start having problems. The internet's taking off, Amazon, this, whatever they're blaming it on is coming into fruition. If you knew which people believed what, you know who you could sell things. So I took best example is a sales broker. There's a sales broker who says he spends when it's quiet every Thursday night. It's quiet. He comes back to the office after dinner and everything. He literally stays there the whole night, and he reviews every open sale. And he tries to imagine who's the best real suited for this building. On the market, this building's only worth $12 million. He says, oh, this building, the truth is, there's a college down the road. The truth is, why don't I pitch it to them as a dormitory? To the college, it was worth $13 million. This building, I know some of those condo conversions. Based on the rentals, this thing's worth $12 million. But the truth is, based on sales, he could probably sell this out at $18 million if he sold each unit. Let me go sell it to a condo developer. We'll stretch and pay the price. It's understanding as many people as you could get to understand. I know that this deal is not for a typical owner, but here's a family office that doesn't need a return today. This is a deal that the neighborhood's changing. It takes 20 years, 30 years to really reach its value. This investor is a 30-year hold type investor. So the same way you know all those things, that's what helps syndicators buy the right deals. And many syndicators start off as sales brokers. They just said, why am I selling a building for $10 million and making a $300,000 commission or a $500,000 commission? Why don't I go out there and syndicate it? And instead of making $500,000 up front, make myself $100,000 to $200,000 a year for the next who knows how many years. So they use that same thought process to understand the people and the players in the game, who to bring in as a partner, what return they're willing to give up, how they can make their money, and get things going accordingly. In some cases, a syndicator, like I said before, may want to join in with other syndicators / investors if they're either competing on the same deal or don't have other deals to buy, usually pari passu. So the first part of this is what, like I said before, two syndicators, either they start before they buy the building. They find out that they're bidding against each other. Say, why are we competing against each other? We're just one of us is gonna win and pay $1 million more. Why don't we just both agree to only pay $12 million, and we'll split the deal. A. Or B, they come in after the fact. I won the bid, but I can't raise all the money. So I find someone else to join me as a co-GP or co-syndicator, and we'll do it together. However, when it comes to two partners, two GPs buying it, they buy and they do everything as pari passu, which means exactly even, dollar for dollar. It doesn't mean $1 for $1. It means that whatever ratio they agree, how they're going to raise the money, they do it evenly. So if I say I'm doing 60% and you're 40, you're responsible for 40% of everything. You get 40% of the gain, 40% of the loss. I'm 60% of the gain, 60% of the loss, I'm responsible for 60. That's the definition of pari passu, that everybody is even. Typically, on the other hand, the money between a GP and an LP is not pari passu. It's like a waterfall. The first money that comes back, the preferred return to 8%, he gets all of it. The next money, he gets 70% of it, and the GP keeps 30% of it, whatever the split they agree to. And sometimes it gets very complicated. What happens if a GP says, this building, it's gonna be a grand slam. It's gonna be the best deal ever. And the investor says, let me tell you something. I do every deal under the sun. After I get 8% on my money, I get 70% of the profits. That's all I'm giving you. He goes, but it's a home run. I'm bringing you a deal better than every deal you're doing. Give me more. So usually what ends up happening is they come to terms and say as follows. A regular deal, let's say, should throw off a 12% return. A home run deal is better than 12%. So the investor, the LP, would say, I'll tell you what. I get my 8% preferred return. I get the 70-30 split up until 12%. Every dollar of profit above 12%, no problem. On that deal, I'm willing to only take 60% and you get 40. So it's a waterfall structure that allows, now also the GP is now motivated to really make this deal into a home run, to make the deal work. But I want to give an example on the syndic financing where sometimes the GP and the LP have different motives in mind. They close on this transaction. And I said it in one of the previous courses, I guess I'm talking about the financing and the other way around. I'm going to say it from this side. The GP comes to refinance the building 5 years from now. He has an option 5 years from now he has right now, the loan now has a prepayment penalty to pay up early. But he says, if I refinance today, I don't care about the prepayment penalty because I can now return all the money that I borrowed back to the LP. And going forward tomorrow, because he got all his money back and he's already got his 12% return, I'm a 60-40 split. I get 40% of the profits. So he's not going to care about the fact that he's paying extra fees now. He's not going to care about the fact that he's paying a higher rate than he started with. He cares about one thing. As of tomorrow morning, if I do this transaction, I own 40% of the deal. The LP is in worse situation twice. He's the one, he sees extra fees going into the deal. He sees a higher rate going forward. And also he has his money back today, who says he has what to do with it, and he only owns 60% of the deal right now. The motives are not aligned at a certain point. So I'm just giving you an extreme example. Usually it's not that far off. But when someone's doing a deal, when you meet certain people, that's why, like, when you meet, the fiduciary responsibility of a stock is to care about the shareholders. If I'm running a company, this is a publicly traded company, tomorrow morning, I get commission on a deal. So it's in my best interest to keep running this business and get commissions. What happens if there's an offer to sell the whole company? It's better for the shareholders. I have a conflict of interest. If I sell the business, I'll make whatever small percent of the business that I own. It's publicly traded, or I'm just the president, I'm a salaried person, I'll make a bonus. But if I don't sell it, I have a job here. And my job, I could keep earning the money I'm earning for many years to come. The fiduciary responsibility is to have the shareholders' interest involved. Same thing on real estate. Who's the fiduciary responsibility to have when they're going ahead and doing those transactions? It's important to be familiar with the business plan of all parties involved. The seller, the buyer, the sales broker, the lender, and even the tenants likely have different objectives. It's the same situation I'm saying before, just with the partners, go with everybody. Because, for example, if you understood the tenant's needs in the building, on a commercial tenant, you know that the person has 2 years left to the lease. It's in my best interest as the buyer to renew that lease, because then I'll get better financing because I have a long-term lease in place. It might be better for this tenant also. Or no, this tenant is better off waiting because they have all their options. If the market changes, they have the upper hand. So if you go into a deal thinking you can do A, B, and C, but you didn't speak to the tenant, you have no idea, you can be in trouble. You don't understand why the seller is motivated to sell. So sometimes you have an opportunity, a seller has to sell because maybe they have another capital call to come up with money. So in a normal sense, I go into contract on this building. I'd say I have to close at the end of June. I think to myself, even if I don't close by the end of June, I'll come up with extra money. I'll give an extension fee. I'll pay the fee to go further, and I'll carry it out a little longer. The problem is that the seller, I never spoke to the seller. The seller needs the money June 30th. So I go over to the seller, $100,000 extra doesn't make a difference to him. He needs $2 million extra. Sometimes the reverse is the case. You know this up front. And the seller's trying to do a fast close. But no one can close that fast. But you're getting a great deal if you close that fast. And really, sometimes, someone can make a negotiation, tell the seller, what do you have to close fast? Because I need $1 million of it. Because what happens if I give you the $1 million, I release it from escrow tomorrow morning? So I'll go hard on the contract. My contract's for $1 million. I'll let you use the $1 million. So now you have the $1 million for what you need. You're now getting an extra 4 months. And because of that, the buyer can be at better terms. So if you understand everyone's motivation, not just taking fact, it's the same thing for those who are doing sales calls. The guy says he's not interested. And whatever you sell, like, why are you not interested? Why not? Why did we were talking, you fell off the planet? Ask the why, fact find. Ask the why to the point that you fully understand, so then you can make an educated decision. Like Cy Sim says, the educated consumer is the best customer. Some people thrive on the fact that people are off market, no one knows what's going on. Those people don't make money in the long term. I say, playing chess, if you're playing a game of chess, is it great because the person made a mistake and that's how you won? I'd rather tell the person your next move. And if you're going to win or lose, you win or lose because everyone sees all the moves that are on the table. So it's full disclosure, upfront, and that's how you win. You win because you have an idea how to deal with all the pieces of the puzzle that are open in front of you. I'm going to go through these pages a little bit faster because we didn't previously, but I'm going to show you, I'm going to point out the points that are relevant for what I want to get to for this section here. So this is the regular setup we discussed before. This is how a buyer, a seller, a broker will send you a deal and show you what the deal looks like. And to point out what I said in this so far today is the first thing you look at to be able to determine if this deal is for you or not is you're looking at 72,000 as the NOI on page 6. 72,967 net operating income. Because by looking at the net operating income, you could see right away that what you're buying a building, and you're told when you're buying a building in this neighborhood. Let me go back one step. That didn't bring up here. I'll just re-say it here. Before you go ahead and buy real estate, you must have the person, your role model, the person you talk to, the person who gives you advice, the person you mentor, whatever you want to call them. And if you're buying a building, in this case, the Bronx, you have to have someone who tells you what cap rate should you apply to a building in the Bronx. And then the first thing you do is you take the NOI, you divide it by the cap rate, or using the Eastern Mortgage Calculator, so it's in there as a valuation calculator. Type in the NOI of 72,000, you put in the cap rate that you're told by your mentor to use, and that's the value. If your mentor tells you that this area is going to trade at a cap rate of 6, this building's going to be way more than $1 million. And you can't buy it because in the case we have, going with the same example, all you have is access to $300,000. You cannot buy this deal. So $300,000, you call the owner, the seller up and say, listen here, I know that on the market it might be worth $1.1 million or $1.2 million, but at the most I could pay for $1 million. Is it available? If he says no, move on. If he says yes, you could proceed. But your proceeding is to make sure that it's not higher than the cap rate. If your mentor tells you this deal should trade at an 8 cap, and this building is for $900,000, you're not going to overpay. So you're paying the lesser of what your mentor tells you it's worth and what you could afford. So if it's only worth $850,000 according to your mentor, I don't care what the seller's telling you. You're trusting your mentor. $850,000 is the number, and that's you're going home from there. But at least you know if it comes to $850,000, you could afford it because you have $300,000 available to you. You could buy it for $300,000. That's the first part of this. The second part of this is to figure out the cash and cash, the return that you're able to go ahead and make. So the return you can make is by taking the $72,000 again. There's a full built-in calculator within the app that's going to calculate it for you. You type in $72,000. You type in what the interest rate you think you're getting. You type in the LTV that you're getting. It will tell you what your payments are. It'll tell you what you have available to you. And it'll tell you if you have to put down cash of $300,000, it will tell you what your cash and cash return is, your IRR's your return is going to be. And based on that, do you have a target or you don't have a target? This is where you should spend your time. And within these 4 minutes, you save yourself a ton of time. Because it'll take you less than 4 minutes to calculate what I just told you. To figure out if it's a good deal, the numbers make sense, and all that afterward, It's hours and hours and hours of work. So why spend the hours of work if you know you could eliminate a high percent of them quicker? Also, if you had 10 deals to look at and you decide, you know something, I'm taking my Sunday off, I'm going to go look at properties. If you have 10, you might not have a chance to drive by all 10. If you go to Knicks before that, 6 of them, because they're never going to make sense, you have only 4 deals left, you get into your car and you can focus on those 4 deals. You have a better chance of understanding the deals that do make sense and be able to strike a deal to be able to go ahead and buy it. That's the main thing for the purpose of this conversation you can on the first page. Okay. The second page is just repeating the setup for those who are just starting here, and you see, you know, the rents, etc. from there. This next page is showing again what I want to show. In this case, we already established that the rate, it's a 4% interest rate. Bank is lending 75% financing. So you know on this building if it's buying it for $1 million. And in this case, if you go to the bottom right corner of the page, almost all the way to the corner, it's the second to last line, it says cap rate 7.3. That's the example in this case. His mentor told him that this area traded at 7.3. Based on that, he will plug in 7.3. We have the NOI of 72,000. It works out to a value of $1 million. It fits the box. It matches up to his mentor, matches up to his end of it. He can move forward from there. So here's the situation. Here's the situation how it works. If a person bought this building for cash, all cash, they made for themselves about a $72,000, a 7.2% return on their money. That's according to the cap rate. All capital. They bought it for $1 million. It's the wrong of $72,000. Comes out, he's getting a 7.2% return on his money. However, it's actually a little bit less because his purchase price, not $1 million, has closing costs. So he actually put in $1,050,000, and all he got back was 72,000. So on to 72,000, $1,050,000 is roughly 6.95%. It's roughly a little bit less than 7% return. But here's the key question. The key question is, if I'm buying this building for $1 million and it's throwing off 7.2%, how is it that I'm able to continue with my dialogue and promise I'm going to 10% return on the money or 9%? There's no 9%. There's only 7.2. So I'm going to explain to you this is how leverage works. If you go on to the next page, page 9, this is how leverage works out. Let's say you have your own funds or raised OPM, other people's money, to buy a $1 million multifamily property building in Bronx, New York. It's this example, as I kept the numbers round here, plus $50,000 closing costs. It has 24 units and a monthly rental of $18,000. Your rental income every year is $18,000 times 12. That's that rental, $216. After adjusting for a possible 5% vacancy, you're left with $205,000. That's the math on the pages before. Subtracting all your yearly expenses, your $132,000, which is the management, taxes, insurance, fuel, leaves you with an NOI, a net operating income of $967. You bought at a 7.29% capitalization rate, cap rate, and your unleveraged cash and cash return, so $72,000 divided by $1,050,000 is 6.95%. So you got 6.95%. However, if a bank is lending you 75%, $750,000, then you're only putting down $300,000, $250,000 plus towards the purchase price, plus $50,000 in closing costs. Now suppose your mortgage terms are 4% interest rate and a 30-year amortization. Your yearly mortgage payment is $42,000. So it works out in this deal, if you're thinking about it just a little bit differently, how the concept of leverage works is because you're buying a building for $1 million that's throwing off 7%. Okay. However, you found a bank that's going to lend you $750,000 of it. They're only going to take this much money. On their $750,000, there's still a little bit of profit. So you're taking that profit on your $300,000 you're putting in. You're making the same 7.29%, 6.95. Sorry, after the closing cost, that's 6.95%. However, you're also throwing in the profits from that the bank's leaving on the table. The bank's not taking all 7.29%, they're only taking 4%. So the bank left on the table $20,000. That $20,000 now, it helps your return on your $300,000. And that's what happens here. So now your investment is only $300,000, $250,000 plus $50,000 in closing costs, and your final return is $30,000. It's the 7% of that you were having before plus the $21,000 in profit. The total return, because you have a building that's $72,000 in NOI, your mortgage payments are $42,000. What's left over is $30,000. That works out to a 10% cash on cash return. So that's how a building over here that you're buying without a mortgage is throwing off 6.9 or 7.25 by leveraging it up there, by allowing you to take the profits from the other money, which is cheaper, it goes. Now, by leveraging the deal with financing, it allows you leverage cash on cash return to be 10% as opposed to 6.95%. Okay. I want to explain a very, very important concept that I find that people even in the business for a long time have a tough time comprehending and understanding and how it works. So I'll take a page out of business, not out of real estate. When somebody goes into a partnership, and use a great example of a pizza shop. Two people open up a pizza shop together. Even partnership. Each put up $150,000 for the $300,000 that they need. They're 50-50 partners. Profit should be split 50-50. What happens if the manager of the pizza shop quits and one of the two of them decide to become the manager? Do they go into the pizza shop and do it for free? No. One goes in and the partnership pays them a salary. Let's say $100,000. So now at the end of the year, let's say they didn't have a position manager before. One of them becomes the manager. This business now throws off this year $300,000. It throws off also this year. It's not split 50-50. One gets $100,000 for their salary. There's $200,000 left. That gets split 50-50. So one of them is walking away with $200,000. One of them is walking with $100,000. So it's not fair with 2/3, 1/3 partner. It's supposed to be 50-50. No. One has an employment agreement that they have a job that they work there. And they still split the profits 50-50. So this is the key thing to remember. Partnerships, equity, is forever until you sell that business, until you sell that building. Employment agreement is separate. So for example, if after a couple of years, this manager decides to quit and doesn't want to manage the pizza shop anymore, and instead they hire someone else, whether they pay that person 75, 100, or 125, the partnership stays the same, 50-50. If they have to pay that new manager in the same profit margin, they pay the new manager only $75,000, there's $225 profit, they each get $112.5. They split that $225, they split it between the two of them. The same thing happens on a real estate transaction. When someone invests in a real estate deal, they stay a partner forever. Whatever their partnership split is. There's no concept, oh, you got your money back, you're not my partner anymore. No. We buy a building together, 4 people. I'm the GP. I own 25%, and I take partners from 3 other people. Each of them put up $100,000, and now, each in the deal we have, they each own 25% of the deal. If I do take out a mortgage in a few years from now, and I cash out, I'm able to, above and beyond my balance, I could borrow $300,000, and I give each of them their 100 back. They are still my 25% partner forever. In partnership stays forever. That's how it works. There's a separate discussion called employment. So, when I come to the table, I say, hey, my name is Ira, and I'm managing the property. So even though whatever I own, but I need a management fee. I need a salary of some compensation to manage. But on the other hand, each of the partners could turn back to me and say, okay, that's fair. But our money is doing the work. While our money is parked in this building, we can't invest it anywhere else. So our money needs a salary also. That's what changes over time. So that's what's called in the industry called a preferred return. A person who owns an LP invests in a piece of real estate, or anyone invests in real estate, they would agree to 2 things: how much ownership they have, and how much is their money making them. And that money is what they call a preferred return, a 6% preferred return, an 8% preferred return. And then what happens throughout the life of the investment is that year 1 is $300,000 of invested money. Let's say they were promised an 8% preferred return. That's $24,000. The first $24,000 gets given to them as their salary. Then there's $6,000 left over. That's split evenly amongst their percent partnership that everybody owns. If in 5 years from now, or 7 years, or 2 years, or 10 years, I'm able to refinance the building, and there's $300,000 in available cash, I go back to them and say, I'm firing your money now. Here's your 100, here's your 100, here's your 100. Starting tomorrow, you're still a partner with me, but when there's $30,000 to split, you don't get anything before me. You don't get a salary for that money. You already have your money. Let it work, get a job somewhere else. And instead, what happens is we just split that $30,000 based on our ownership stake within the business. That's how it works. So the confusing part is, give back the money, what do I still get? When you give back the money, the only thing that changes is the preferred return that goes in there. Now, those of you who understood everything I just said till now. I'll tell you another point that's very complicated, but I'll take it to a next level. It's not really relevant for you to know, since sometimes the deals get negotiated. Very deep negotiations sometimes go back. It's what is called a return of my capital, what's called firing my money, and what's called profit sharing. So what happens if 1 year there's $80,000 available? So he gets his $24,000 given out to the money people, the salaries, and now there's $54,000, there's $56,000 that's left over, and then you distribute it. Is that next year, that $56,000 that you gave out to them now, called a return of the capital, that next year they only get 8% on 250, 240, whatever, 246, has that 244, does that work? Or no? Most common deal is, that's not called a return of my salary. I only get a return of my salary when there's a big capital expense. Things happen, one of two things. When you refinance and when you sell. So until you refinance, that year's $80,000 distributed and everyone gets their money, the next year it starts again. I get my salary. It's called like a bonus to them. That's their equity, their profit. However, when you refinance the mortgage that year, that money gets distributed as a capital call, as capital, and then the next year it goes to be partial. So what happens in a partial case is, what happens if they only cash out $150,000? So they get back half their money is fired, gets returned as capital, and going forward, they get 8% on the $150,000 remaining, not on the $300,000. So they get 8%, and then they get that percent profit. Now we'll go back to the normal broadcast up until now. So here's what is a syndicator and how does a syndicator make money. A syndicator is the one who puts real estate deals together. He gets, his salary is a management fee. Typically, a syndicator will manage the building or split with a local manager 5% of the rent roll. So the building, the partnership who owns it, says, please manage the property. Many times, it's not given to a third-party company. That's how the syndicator makes his living. I have this building. In this case, we have here a $216,000 rent roll that comes in. They collect $216,000. He gets 5%. He'll get $10,000 for overseeing this building. All the expenses are paid by the building. But who's going to manage it? Who has a salary to manage the coming and going, what's going on? That's that management fee. Sometimes what will happen is that the partners would say, you're not qualified to manage this property as a syndicator. We'll give you partnership in the building. You found us a good deal. You'll put it all together. You got to find yourself a third-party manager. And sometimes if that's the case, the manager might make no money. The syndicator makes no money in management because he's not working on the building. However, many, many times in that scenario, the syndicator will make a deal with the management company and co-manage it. And he'll say to the management company, I'll give you this account at 5%. You keep 4 of it, I'll keep 1 of it. And it satisfies the partners because it even helps them. Their syndicator is within the management company. And the management company is happy because they got the account and they actually have someone who's actually helping them at the same time. So that's what typically happens in many cases. But the most common, if someone's an experienced syndicator, he gets management. He might have his own management company under him, but he gets the management. Now here's another very important point I tell people. Sometimes there could be someone who buys a piece of real estate and syndicates it. It's not the greatest deal in the world. And you might take a long time till you make your return. Why did he buy it? It helps his management company. He buys a building next to, he owns a building down the block. He already has staff on there. There's a building down the block with $2 million in income. 5% is $100,000. He says he has $100,000. So that's my example before of understanding everyone's motive. It still may be a good investment, but you want to fully understand what his motives are. How does he make his money? That's why when I meet people, I want to understand, how do you make money? If I understand that you make money, I know your ulterior motives. I know when I have to raise a flag that potentially there's a conflict, and I know I don't have to raise a flag in the world of full disclosure. Acquisition fee. Typically, the syndicator is going to make, at the closing, a 1% of the purchase price, an acquisition fee, which basically covers him. He's in business like everyone else. He's been running around looking at 400 deals, narrowing it down to 20, narrowing it down to 10, looking at the properties, negotiating this. Sometimes he spent money dating people, going out, shows, conferences. How does he get that money back? He has to get that money back, but when he finally closes the transaction, he takes himself a 1% asset management. The promote. Promote is that word, that profit margin. So after the investors collect their preferred return, that's that salary for their money, that 8%, 6%, everything is negotiated. A syndicator will typically, I should have wrote the word, earn 20% or another agreed upon number of the remaining profit. His promotion can be part of future revenues as well. That's cash flow, growth, refinance, and ultimately a sale. So promoters are saying before, they agree that I'm going to invest, and LP says, I'm willing to invest $100,000 a year. I need a 6% preferred return. After I get my preferred return, after my money got its salary, I'm willing to give you 20% of the profits above that. And that's how they run the operate. So this way the LP knows that the GP, the syndicator, is motivated to make this building successful. So when you meet most people in real estate, that they started buying real estate, their first deal with other people's money, they may be very powerful in the fact they control that building. They control which vendors they use. They're the general partner. They're making very little money. Their money only kicks in after everyone makes their money back, which is typically not going to happen until the next refinance or they eventually sell the building. The miscellaneous fees. If the syndicator has another business or the opportunity to make use of his own services for this property, this has to be fully disclosed. So, for example, a syndicator owns a trash removal business, snow removal. He could say to his investors, I want to let you know that I own this other business and I plan on using them as the vendor. They might say, no problem, as long as you get 3 bids and it's the cheapest and whatever they want to work out. But there's other ways he makes money. This last point is very, very big in the nursing home business. The nursing home business, the ancillary businesses sometimes are worth more than the nursing home itself. In real estate, it's not really so much. The building is worth more than the ancillary businesses. But it could be you have a side business you went in from before you went into real estate. You have a side something, and you use that service as you go into it. So over here, I wrote the word typical, a typical syndication. I'll walk through again. I'm going to use the same example we used before. I'm going to use it over here. A building was bought for $1 million plus $50,000 in closing costs. $1 million plus $50,000 equals $1,050,000. A bank will lend 75% of your purchase price. $1 million times 75% is $750,000. The cash that's needed is $300,000. The $1,050,000 minus the $750,000. Assume the NOI, the net operating income, after the mortgage payment, which is called the debt service, and all reserves and expenses is $30,000 left over. So your overall cash and cash return will be 10%. Using the above example, where the investor's preferred return is 8% cash and cash, the first 8%, $24,000 of that 30, is taken by the investor as the salary, so to speak, for his money. The remaining 2%, the $6,000, is split. The investor gets 80% of it, $4,800. The syndicator gets 20%, $1,200. The investor will ultimately earn a return of 9.6%. His preferred of 8% plus 80% the remaining 2%, which in this case is $4,800, which works out that on this deal, the LP is investing in the deal is getting 9.6. Total return is 24,000 plus 4,800 is 28,000, and 28,800 divided by 300,000 is 9.6%. Syndicator is making 20% of what remains after the preferred return. In this case, is $1,200. His total take in this deal year one is $12,000. Now I'm going to go off and tell you, I'm going to date the material now. Until now, everything I've told you will apply for all of time. From the beginning of real estate to the end of real estate, just a matter of 8%, 6% preferred return, how's it work? And now I'm going to date it to the market when running. Real estate is a very, 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 very boring business to own. Very boring. Buying a piece of real estate, collecting the rents, dealing with regulation. You have tenants with problems. You have to deal with them. This thing goes up. This expense is up. It's a very boring, long business. If you're lucky, you bring your NOI from $72,000 to $74,000 to $78,000. Every year, you slowly move it up over time. It's a slow, long, tedious business. What made it beneficial to most people, aside from the tax benefits that it had, is that real estate became so popular in the last 10 to 15 years. And financing was so, financing was the big key thing for it. Is that rates went down, banks became more sophisticated, better leverage, structures, all these things, internet changing regulations and laws and who knows what, allowed that so many people got interested in real estate. So real estate used to be something where, like I said before, you have investment opportunities. I put money in the bank 1%, I put bonds at 2%, this at 3%, this at 4%. It used to be real estate used to throw up 20, 25, 30% a year on their money. Because real estate was considered a dirty business. You want to go collect rents and find your tenants and vacancies. So people made a lot of money on it. It became so accepted today. So much money was competing on it that people made money in the last few years simply by doing nothing special. They bought a building, did their job, but the neighborhood changed. Cap rates dropped. Rent rates dropped. Rents just popped up because the real estate became hotter in certain areas. And then he bought a building for $10 million, was able to sell it for $12 million. But just remember something. When someone goes from $10 million to $12 million, that's a 20% increase. However, that's almost doubling or tripling your return. Because you bought the building for $10 million. You took out a loan for $7.5 million or $8 million. You put in $2 million. When you now sell it for 12, you made $2 million profit. You doubled your money in some cases in 3 years. Sometimes some deals went from 10 million to 15, or 10 million to 20 million. So people making so much money in real estate that there was a level of excitement that was to it. When I used to hear people pitch deals, we have an equity department. People used to pitch deals, oh, in 3 years we'll cash all the money, get all your money back, plus you'll own a piece of the business for life. It's the greatest investments in the world. You get all the tax benefits on top of that. But now what's happening now is we're in a rising rate environment. The opposite is taking place. People aren't buying buildings today. I don't believe they're cashing out their money in 5 years from now. It's going back to being a long, boring business. Can you make a return? So if I was the syndicator on this deal, and I knew big deal, so I make my $10,000 plus my $1,200, but 5 years from now, refinance the building, we worth $1.5 million. Everyone gets back their money. I get a big lump check for $50,000 now. Plus, I start making my 20% of the building because everyone got their money back. So I own 20% of the building for free. It gets exciting. I buy another building. I don't think that's happening. I think this guy's buying his building. If he's lucky, his investors are just breaking even. Sometimes have problems and reinvest the money into the building. He's not going to even throw off his full 8% return. He's going to barely do it. So he's making no money at $1,200. Maybe even worse off. He may have a slow year. He's making only 6%. So he owes the investor next year 10%, not 8%, because he has to catch up from the year before. Comes to refinance, he's not going to be able to borrow $1.05 million in 5 years from now. He'll only be able to borrow $900,000. So he gets back half the money. So he still has half the investor getting a preferred return on the money. And it becomes a long, boring business with issues that come up throughout, if there's issues that come up throughout the whole entire process. So this is a matter of an opinion. But if you play it out there, logic is going to dictate because you analyze what happened, how we got to where we are. We got to where we are very simple over the last 20 years. Interest rates were here. They went down to here. Naturally, everything you heard, it meant there's a better return on your money. If there's a better return, the seller said, why am I letting you, the buyer, buy my building for the same $1 million? And instead of making a 10% cash-on-cash return, if this building had a 3% interest rate, the cash-on-cash return would be higher. Why am I letting you keep the difference? I want some of the difference. How do I keep the difference? I don't sell for $1 million. I sell for $1,025,000. So I made $25,000 more. You also benefit. You'll make a 10.5% rate. And as competition came in, people were getting nervous about investing in other things. So not only was the change is that the rates went down, when that syndicator was looking to raise money, he found people that didn't want to invest in the stock market. And he was sitting on a lot of cash. And he said, why are you letting all those people make money in the real estate market? They're making 10%. So I said, I'm willing to make 8%. So in the beginning, the syndicator benefited from it. He promised a lower return, get better yields, return for himself. But after a while, it got all priced in. The seller said, everyone's willing to make less, let me charge more. You, Mr. Syndicator, could buy this building even at $1.1 million because your rate's 3%, your investors only need an 8% cash-on-cash return, not a 10% cash-on-cash return. And that was the cycle. But what's happening now is the pendulum is switching. As the pendulum is switching, all those things are going the opposite. Interest rates started to rise. So it rose up, maybe it took a break a little bit now. Now there's uncertainty what's going on. But everyone thinks it's either going to keep going up or stay flat, not going down. So people are adjusting to the new world order. So in order to buy the same building and give everyone the same 8% returns, you have to pay for this building, not $1 million, the opposite. You have to pay $975 for this building. What happens if the investors say, oh, I invested with you because I thought I'm getting back my money. I was willing to tie up my money for 5 years, get an 8% return for 5 years, and in 5 years refinance, get all my money back, I can do something else with it. You're telling me I'm going to have to keep my money locked in this building for 20 years or 10 years? I only get half it back in 5, another half in 10? Oh, that's the case. I want the flexibility. I want to get a 10% return. Goes back to the seller. You can't sell this building anymore for $975. $950 is the price. So you could look at it and say, what's the big deal? Seller either won't sell or will sell. What's happening now is transactions overall are slowing down overall because sellers are saying, I have a building throwing off $72,000. I think it's great. If I could get $1 million, I'd sell. If I'm not getting $1 million, I'll just keep the building. So less buildings are trading hands because of it. But even if buildings start ticking back up in the marketplace, at the end of the day, the up and down is that the different price points are going to mean different things to different people. And the prices overall, rates tick up a little bit more in rates, the whole cycle starts again. And what happens in 5 years from now? I projected, okay, I'm not going to be able to cash out all the money. I'll cash out half. Really? Maybe cash out nothing. Maybe the building in 5 years from now will be worth, again, it's $1 million or $1.1 million. And 75% is only $800,000. You're right. I paid down $50,000 on my mortgage. I could cash out 100. That's not real money. As people start getting this information comes back to them and it seeps down all this information, people are going to wake up and say, I want a 12% return on my money. Real estate won't have, or I'm not investing in real estate. I have other investments. See, when I go out to a bank sometimes, I tell the bank, you have to lend money. How are you slowing down? He goes, I have to lend money. But who's I have to lend on real estate? I can lend to businesses. I can lend on different types of properties. I could lend on, I could do different things with my money. I can buy bonds. I can buy stocks. I don't have to just lend on real estate. That's the same thing. And as less people invest in real estate, with less competition, it's self-fulfilling to the negative like it's self-fulfilling to the positive. So the one thing I can tell you is as a fact is as follows. The domino happens this way, I describe it. The assumption is, where do you think rates are going? So it boils down to rates and the economy in general. If you think rates are ticking upward, what I just told you is definitely happening. You think rates are staying flat? No. This is at a bump here. This is the new world order. Reassess everything. This is where we're at right now. But what's happening is also on the general economy. Is the economy getting better? The economy is getting better. That means, yes, tenants can afford to pay more. But the economy is getting better. You also have, on the other side, interest rates go up with the economy getting better. So you can't believe the economy is getting better without interest rates going up. And on the other side of the equation, if the economy is getting better, then there's other businesses, people open up other industries and other businesses. So the people who have investment dollars won't just invest in real estate. They'll invest their investment dollars into other things all at the same exact time. They'll have to move into different situations to go forward. I want to go with one more slide before we end this. I gave you an example of how equity gets syndicated. You have to raise money, how different people can invest in, different promotes, different returns. So I want to explain to you how the CMBS market, Wall Street, came about and what happened. Banks were lending. The general idea is that banks are regulated. So that generally take the middle of the road. They're not that aggressive, they're not that conservative. And they price themselves properly. They lend 75%, $750,000. Everything is great. They go home, get that rate of 4%. The safest investment in the world is to invest in, the people that make the safest investments, the most conservative investments, are life insurance companies. So MetLife, for example, why they can make the safest investment? They sold life insurance. They know that every single one of their policyholders is going to die. The only question is when, so how long do they have before they have to make that payout? And is the person going to lapse, stop making their payments on their insurance before they actually die? That's the only consideration that they have. So they have to make investments. They can afford to lose money. They could grow slowly, but they can't afford to lose a penny. They can't go backwards. As an investor, you could afford to lose money on one deal, make it up on 3 other deals. They don't have that much room because in the best case scenario, they make very safe investments. So they're only making 2-3% on their money. They can't afford to go backwards. When you're making 12% on your money, you go back on one deal, catch up on the next few. So who takes the risk? Who's going to take the biggest risk? The entrepreneur, the real estate entrepreneur. This guy has a lot of money. Check the news now. A lot of these real estate owners are starting to become lenders. They know the value of real estate. This building is worth $10 million. They wouldn't buy it because of what return are they going to make? 8%, 9%? It's not enough for them. But there's nothing risky out there to left. So what do? They'd rather find the guy buying it for $10 million. And he can't get a bank loan day one. Or he gets a bank loan only for $8 million of it. And he says, you know something, I'll lend you $1 million as a second mortgage. I'm not getting into the legalities of it, but the concept. I'll lend you $1 million as a second mortgage, but I want 12% of my money. Going back to everything we did till now is to just calculate what's his return on the first money, on the bank money, but then there's 12% on the rest of it. Let's say go the better example here. Assuming this deal we had here was that a person was willing to lend you from $750,000 to $850,000, $100,000 more at 9% interest rate. You would take it because you could leverage even higher. The bank is taking 4% for the first $750,000. This lend, then you have another lender taking 9%, right? What's left? You have 10% left over, cash and cash on this deal is 10%. If I find someone who's willing to only take 9% on my money, on 100,000. When I raise 150,000, I'll get my same 10% cash on cash plus the profit, that extra $1,000, which will increase my return on my money. The same idea of leveraging, keep leveraging it up. The problem is that how many people could afford to pay 8, 10, 12% interest rates? Not that many. Not that many deals. A vacant building, a buyer might pay it. Most deals are regular deals. At the same token, life insurance companies lend money on real estate. They lend money on beautiful real estate, 65% leverage. As they say, there's no room for something to go wrong. Real estate never on a cash flowing building in the history of real estate corrected itself by more than 35%. So they lent $65 million on a deal. It was worth $100 million. The real estate market crashes. It never crashed and dropped more than 25, 35%. So therefore, they're covered. And even if the real estate is worth less, it's still cash flow there. So if they lend at a certain ratio, it's called very safe. Same problem is, I don't get too many phone calls. The guy goes, I'm looking for a mortgage. I only want to borrow 50% loan to value. It's the opposite. I want to borrow the most I can to pay back my investors, to use the money to buy more buildings and so on and so forth. So Wall Street created was a scenario where I said before that banks sometimes partner up. Two partners come together even. Someone wants to borrow $50 million. A bank has a lending limit of $25 million. Two banks come together. They lend one loan of $50 million. They're pari passu. If there's a loss, they both take it. If there's a gain, they both take it. They may decide to go into a deal 30 million, 20 million. Then the pari passu 60-40. But that pari passu, something blows up, it's even. One of them will take on responsibility to manage it, to manage the loan, and they'll get an extra bit of the profit as a salary from managing the loan throughout the process. But CMBS came up with an idea. It's called, why don't we make a partnership, not pari passu. First position, second position is one loan. And Wall Street walked over to that life company and they said, listen, you're making very little. You have more money than you have deals to put in. I could bring you a lot of deal flow. If you're willing to allow a second mortgage behind your building, behind you, I'm willing to pay you a little bit higher interest rate. If you were earning up until now 2%, I'll pay you 2.5% on your money. It's riskier because the person, they're only lending the person the same 65%, but the person now has a second mortgage behind them. So they could be a little bit stressed out after they pay two payments. But on the other hand, the person who's lending them that money is very, very strong. And if there's a problem, you could be sure. The only way you could lose your money is if they get wiped out. Because if the building sells, $1 million building sells for $650,000, who gets the $650,000? We're not going even as a partnership. You'll get first position. You'll get your money out first. You'll be safe. You could be sure that that other person is not going to be wiped out. So you have an added security blanket. You're taking more risk, but you have someone who will probably step in and make sure, deal with the fighting and deal with everything in the middle. Life company said, yes, great deal. On the flip side, they turned over to the companies that make bridge loans at 12%. They want to take crazy risk and say, listen, you're risking vacant buildings, stories, people with problems. I'll give you regular apartment buildings. And I'm not going to go up higher than 80%. You only have to go to 90%. But don't make 12% on the money. Make 10.5%. They said yes all day long. And a shingle was hung up at Wall Street at left field. It said, we are going to lend money 80% leverage at the same 4%. The whole world came to them. Why would you go to a bank anymore? Same deal. I could borrow the same 4%. I can make a much better return for my investors. I only have to get $250,000 down instead of $300,000. And I'm able to promote an extra $800,000 and paying 4%. No higher interest rate. It's like there's a decision, $800,000 at 4.25%, the same rate. How they do it? They did it. Here's the example on page 12. $800,000. A piece is $650,000. B piece. So it's one loan to the borrower for $800,000. Behind the scenes was an A and a B piece of the loan. Interest rate was 2.5% and 10.5%. 16,000. I used an example here just showing interest only, not showing principal. How they're paying amortization, just showing just interest. You see that the illustration. 16,250 and 15,750. So the total income comes out to 32,000. 4% of 800,000 is 32,000. That's how these loans went. What made it even more secure is that they took these loans and they pooled them together. They did $100 million worth at a time, where $65 million was life company money and $35 million was the extra money. And they went to the life company. The life company, if one deal got totally sour, the life company was still safe. The life company got the first $65 million from the whole pool. So not only was 65% each loan, but they also got the benefit of the pool. So if at the end of the day, if all the loans got paid off and they were paid off and $70 million was available, they got the first $65 million. So they were really, really secure in that sense. The reason why the real estate crash happened, or bank, the whole thing blew up, is because what happened was, after a while, the life companies kept making 2.5% and watching this other guy make 8%, 10.5%. And real estate value is going up, and every day it gets better. Not only when this building sold for $1 million, looked at the statement, it sold for $1 million too. They're crazy. They said, you know something? They called up and said, I'm willing to go give you 70%, but I don't want 2.5%, I want 3.5%. The Wall Street House ran the numbers and said it was still good. They called up the other guy and he goes, listen, I'm now in a riskier position. More of my money is higher up on the totem pole. I want 12%. Okay. Bottom line is they kept running the math. They realized they could actually lend money out at 3 3/4 even. So with this change, they would lend at 3 3/4. Oh no. They would have to hang up a sign tomorrow at one point. The guy said, then, you know something? I'm really secure. I'll go to 85% leverage. So I want to still pay me 11.5%. I'll go to 85. So the life company's in at 70. This guy's into 15% to 85. Tomorrow morning I hang up a sign. 85% leverage, 4 1/4. Everyone signed up. Because again, if you're taking the money to leverage it to your investors, where you're going with the money, and after a while the competition kept becoming crazy and crazier. They split this into what's called tranches. And so many tranches it was split into. It didn't stop with the life company. There was a life company that went to 65%. There was someone else who went just from 65 to 70. Some from 70 to 75, 75 to 80, 85 to 90. There was someone who was taking the risk. I'll do on these loans 90 to 92%. They're making like 28% on the money. But after a while of competition, there was so much competition, and they're beating it down. The end of the story is what made this whole thing fall apart is not the structure. This was working. Is that the underwriting guidelines got loose. The front lines at Wall Street House said, I'll lend 90% of your leverage. But they listened to the story of projected rents and the story of vacancies and how to deal with this and how to deal with that. So when I was willing to lend out 92% or invest just the top slug, top tranche, I did it assuming I trusted that the Wall Street House followed the underwriting that they agreed to follow. But they weren't following it at a certain point. They bent the envelope a little bit. Because the guy goes, listen, the guy right now on this building is paying me rent of $1,200 a month. The market's $1,600. You saw I did it with the last 40 units. Give me credit today as if I have the $1,600. I'm going to get it in 6 months. You can understand doing that on one lease. Before you knew it, buildings were financed that way. A guy bought a building, got his finance based on the market rents. He held back money in an escrow account until some of it kicked in. Never came to fruition. Things walked. Leases never roll. Lease walked. So the same thing here. What could bring down the real estate market today? Not so much interest rates going down. Rents coming down. If people can't afford to pay the rents, or they decide they want to go downgrade the buildings that they're in. The landlord bought this building, made all his projections to his investors, your 10% return, all that was based on collecting a certain rent and collecting a certain income. That changes. That's the beginning of the end of what happens for real estate.